It started with soybeans, a $14 billion lifeline to American farmers. In just 72 hours, China canceled contracts, rerouted 2.4 million tons, and left U.S. exporters stunned. But what if that was never the endgame? While unconfirmed, analysts now believe this wasn't a one-off retaliation. It was a calculated signal. A test, and America failed.
Every time he says the word tariffs, the prices decline. We are a price taker. The president is going to put a lot of farmers out of business like this.
China's move came fast, too fast to be reactive. In days, Brazil replaced U.S. supply. Contracts evaporated. Prices collapsed, and farmers across the Midwest were left asking the same question. If China can erase a $14 billion trade line overnight, what else can they shut down next? This isn't just about soybeans. This is about leverage, strategy, and a new kind of war fought not with missiles or sanctions, but with contracts, ports, and pricing power. What happens when China applies the same strategy to the U.S. dollar? Before soybeans were pulled from the table, something else was already slipping away, quietly and with little fanfare. Corn. According to the USDA, U.S. corn exports to China dropped 29% in just the first quarter of 2025. But it wasn't just a dip, it was a rupture. What was once a strategic channel of trade has gone eerily silent.
We're already at a disadvantage, and then we throw the tariffs on top, then that's just not a good marketplace to be in. We've kind of taken second or third fiddle on the soybean production side.
The shift wasn't just about economics, it was psychological. China didn't just pull back, they began unloading. By early spring, China had auctioned off 1.2 million tons of U.S. corn from its state reserves. At the same time, they signed a 3-year, $2.6 billion corn import agreement with Brazil. This was not a reaction. It was a realignment.
We are dependent on trade. China takes more of our soybeans than all other foreign customers combined.
And the numbers paint a painful picture. In 2020 to 21, China accounted for 31% of all U.S. corn exports. In 2024 to 25, that figure dropped to near zero. China paid a premium to buy from Brazil, up to $22 more per ton, not because of price, but to eliminate dependency. The move was surgical. It wasn't just about punishing the U.S., it was about proving a point: America can be replaced. If soybeans were the fuse, corn may be the next controlled detonation. The pain didn't take months to arrive. It came in days. In Wisconsin, Doug Rebaut runs an 800-acre family farm. His soybeans used to go global. Now they're sitting in storage bins, unsold.
We don't want to be stuck in the middle of this. We just want to be able to keep surviving and passing our farms down from generation to generation.
China's 125% retaliatory tariff wasn't just symbolic. It made U.S. crops nearly impossible to sell abroad, and farmers across the Midwest felt it instantly. Soybean spot prices plummeted 8.2% in a week. Grain elevators hit capacity. The USDA's April report showed a 13% increase in unsold inventory, the highest April figure since 2019. Behind those numbers are families, ones now facing foreclosure. The USDA now warns that growers in 11 states face a moderate to high risk of insolvency. These aren't theoretical losses. These are third-generation farms losing their lifeline. And when farmers turned to Washington for support, they found silence or bureaucracy.
Farmers are time sensitive. 30 to 45 days to plant your crop, 30 to 45 days to harvest it. And the president came in and put a halt on farm loans. Many farmers don't have a farm operating loan in place. He froze grants, and he's closing up the offices.
Even if subsidies arrive, they come with paperwork, delays, and restrictions. Not cash, not seed, not fuel. Meanwhile, China's pivot to Brazil appears permanent. According to Reuters, U.S. soybean exports could decline another 20% in 2025 unless new agreements are reached. But Beijing isn't picking up the phone. In Iowa, in South Dakota, in the Dakotas, this isn't just a trade dip. It's an unfolding economic fracture. This isn't a trade war anymore, but it's a harvest collapse. It's easy to view China's exit from U.S. soy as a sudden blowback, but that's not the real story. This wasn't a last-minute retaliation. It was a long game, and China had been setting the pieces in place for years. Between 2020 and 2024, Beijing poured $8.3 billion into agricultural infrastructure across Brazil. They weren't just investing in supply chains, they were building alternatives to America. They co-funded the Ferrocarril Railway, connecting soybean fields in Mato Grosso to the port of Itaqui. They built grain terminals, expanded highways, and embedded Chinese control into the very corridors that now feed their population. By early 2025, transport times within Brazil were slashed 42%. Export costs dropped 35%. Brazil could now match or beat U.S. export volumes without the politics. At the same time, China raised concerns over alleged contamination in U.S. soy shipments, citing trace pesticide and fungal residue. But here's the twist. USDA and WTO audits found contamination rates below 0.01%, well within international food safety norms. No violations, no recalls. This wasn't food safety, this was a regulatory smokescreen. Beijing isn't just buying food, it's buying leverage. That's how one analyst at the Carnegie Endowment put it, and honestly, he's not wrong. Brazil became more than a supplier. It became a strategic partner, a BRICS member with looser GMO rules, lower environmental standards, and no geopolitical baggage. As of Q1 2025, Brazil now supplies 70% of China's soybean imports, and growing. This wasn't America being undercut. It was America being designed out of the system. And U.S. farmers? They're not just losing contracts, they're losing relevance. This was never about one tariff. This is about who writes the future of food and who gets cut out. When China shut the doors, many assumed Washington would rush to the rescue. Instead, the reaction was muted and, in some cases, disturbingly supportive. In states like South Dakota, where agriculture is an economic lifeline, political leaders haven't sounded the alarm. They've defended the very strategy that's tearing through their own base. Senator John Thune, when pressed about Trump's trade war, said, "That's how Senator John Thune defended Trump's trade war strategy, insisting the president deserves room to negotiate, even as farms across his home state edge toward collapse. But the deals aren't coming. As farms teeter on the edge and grain silos overflow with unsold crops, that political loyalty is beginning to look like quiet surrender. Many in these communities are starting to wonder, is this sacrifice or abandonment? Even John Boyd, a longtime farming advocate, was blunt. As John Boyd put it, farmers weren't just hurt, they were abandoned. Frozen loans, collapsed prices, and mountains of paperwork instead of real help. What's even more striking is the strategic silence. No emergency hearings, no farm relief legislation, no strong statements from conservative leadership demanding action. In places like Iowa, Missouri, and the Dakotas, all deep red, voters are feeling it. What used to be automatic support is now replaced with whispered frustration, second-guessing, and talk of betrayal. This moment isn't just exposing an economic weakness. It's exposing a political one, too. When loyalty becomes a liability and support goes unanswered, even the most faithful constituencies begin to fracture. What began as a rallying cry for economic nationalism may be remembered as the moment rural America was left on its own. This was supposed to be a show of strength. Instead, it's starting to feel like economic abandonment. Soybeans were just the beginning. Corn followed. But what comes next could ripple far beyond the fields, into Wall Street, global banking, and the dollar itself. While U.S. farmers scramble to find new buyers, China has been quietly restructuring its entire trade map. According to HSBC's April 2025 commodities report, China has now signed multi-year food import contracts with Brazil, Russia, Argentina, and Pakistan, covering over 70% of its total grain and oilseed needs. Here's the real kicker. Many of those deals are not denominated in US dollars. China, through BRICS and bilateral partnerships, is increasingly pushing for yuan-based trade agreements, effectively bypassing America's financial influence. What began as a trade pivot is starting to look like a currency shift. The message is clear. Beijing doesn't just want to reduce dependency on U.S. agriculture. It wants to reduce dependency on the U.S. system. And if that trend continues, the implications could be massive. Reduced global demand for the dollar, declining U.S. leverage in international finance, higher borrowing costs at home. This isn't a food fight. It's a strategic realignment. Food security was the test case, a low-risk, high-impact battlefield. China proved it could pull the plug on $14 billion worth of trade, rewire its logistics, and stabilize its supply, all within 72 hours. So, what happens if the next phase targets energy, rare earths, or U.S. debt? The fuse has already been lit. In less than a week, China erased $14 billion in U.S. trade and replaced it with ease. No delays, no shortages, no public backlash. That wasn't a disruption. It was a demonstration. America's farmers now face unsold crops, frozen loans, and fading relevance. But this goes beyond agriculture. It's about global leverage, currency independence, and the rise of a trade order where Washington is no longer the center. China is no longer just reacting. It's re-architecting the system. So, the real question isn't whether this was retaliation. It's whether the U.S. is being quietly written out of the future. Is this the start of a new order or the unraveling of an old one? Drop your thoughts below. And if you want to follow the next move, subscribe. It's far from over.